Hello and welcome to number 2 in our occasional series of BTRM market interviews or market videos, let's call them. Today, it's my great pleasure to welcome Kevin Liddy, who is a faculty colleague of mine on the BTRM. I'll disclose interest straight away. He's a close personal friend and we were colleagues at Royal Bank of Scotland, Global Banking and Markets a few years back. Almost many years back now. Although interestingly enough, it's no longer called Global Banking and Markets. I think the division has another name. And I believe RBS is no longer called RBS. It's now NatWest. So we've come full circle 20 years back. And I hope that isn't what we're going to discuss going backwards. We're going to look forwards now. I'm going to discuss LIBOR transition with Mr. Liddy and 3 very pertinent questions, very pertinent to banks, corporate borrowers, ALM managers around the world, I would suggest. So, Mr. Liddy, first of all, thank you very much. Welcome, and thank you for joining us.
That's not a problem. Glad to be here.
So the first question is, if we take what we all understand to be the replacement RFRs, the reference rates for sterling, dollar, and euro, the first question I'd like to ask is, if I am an ALM manager at a commercial bank, what is the key drivers? What are the most important things I should bear in mind as I look to hedge interest rate risk in these 3 currencies going forward? Let's imagine we're in the new replacement regime. What are the key drivers for me as an ALM manager to hedge interest rate risk in these 3 currencies?
Well, I think when I thought about this question, I thought that the most important thing is to have an FTP curve that's RFR based. And if I liken it to the ALM's role as conducting an orchestra, the FTP curve is the baton that keeps, the business lines in tune with the cost of funding, and organizes and coordinates the various areas of the business to get information on the flows that the various business lines are originating, and then can use that and make long-term ALM decisions about how to fund the balance sheet. And the second thing is that a properly constructed FTP curve should capture all the term, what I call the index basis risk. Right? It's not always that's the case. And also it should be cross-currency adjusted, so there's no arbitrage between the various currencies. And this would allow the adoption of a hedging strategy that complements the LIBOR transition and allows the businesses to do their origination or whatever they do in tune with the cost of funds directed by the ALM baton. So I think the FTP curve needs to be RFR based.
So in other words, the internal curve at the bank, if I'm in sterling, is going to be a SONIA curve with any internal adjustment relevant to the bank. If it's in dollars, it'll be a SOFR curve. And in euros, it would be the...
Well, in euros, you got a slightly odd one in euros. In that, Euribor isn't going away. Euribor has been reformed and is staying. Ionia is going away in 2022, and that's going to be replaced by ESTA. But there's less market issue about Ionia ESTA because Ionia is now fixed spread to ESTA. There's no volatility, and Euribor isn't going to go away. So we're really looking at sterling and dollars and yen, Swiss, and Aussie, Canada. But for that, I would say that if you look at where people currently are, they have an FTP or a TLP curve, whatever you want to call it, that is basically a standardized curve based on cost of funds. So you issue in 5 years or 10 years or whatever, public issuance, and then you effectively asset swap it back to 3-month LIBOR. And all of a sudden you asset swap it and you asset swap it at LIBOR plus 50. That's your funding cost in that particular part of the curve, LIBOR plus 50.
So would I now asset swap back to 3-month SONIA or SOFR or Euribor?
Well, I would suggest you swap back to SONIA. There's nothing to stop you doing that today. And in fact, my information is that a lot of banks do actually do that now. The FRN market is all SONIA based. Yes. Term issuance doesn't, when you issue a fixed rate coupon bond, you don't have a LIBOR sensitivity. Yes. You give yourself one when you swap it to LIBOR. So you swap it to SONIA. I think that, the current FTP curves are, as I said, a standardized view of 3-month funding costs. And there's nothing to stop you having a basis to that today, that is the SONIA LIBOR basis. So you can have an RFR based curve. The question about whether if you're a sterling bank, predominantly sterling bank with a single currency balance sheet, then yes, it makes sense to swap everything to SOFR. SOFR is a better hedge for floating rate mortgages. SONIA is a better hedge for floating rate mortgages anyway. And as we'll discuss later, increasingly your origination of loans is going to be SONIA based. When it comes to a bank with more of a multi-currency balance sheet, I don't think you have a separate FTP curve for sterling and a separate FTP curve or TLP curve for dollars. I think you have a sterling one, and then it's cross-currency adjusted into dollars. So there's no arbitrage between the two.
So as long as I've constructed my curve, a term curve linked to that reference, then I'm in business. Okay, understood all that. Fantastic, thank you. Now, I'm going to ask a question about loan origination. So on the business line, lending, I'm either going to be lending, any bank around the world is either going to be lending fixed rate, in which case there's no issue, but I go back to the hedge issue we just discussed, or I'm lending floating rate. Again, in those three currencies, if I am lending in floating rate in sterling, dollars and euros, presumably I want to lend floating linked to either SONIA, SOFR, or Euribor stroke Ester, right? That I shouldn't have any other kind of reference in any origination going forward.
I mean, when you talk about loan origination, if you talk about new origination,
new loans, yes.
As of it's very timely, because as of the end of September, all new origination in the UK and the US had to have, if it was LIBOR based, it had to have conversion terms embedded within it, such that at an agreed trigger point in the future, prior to the end of LIBOR, the loan would automatically switch to the RFR. So it's a very good conversation to be having now, because even today's LIBOR originated loans will convert because the documentation says they have to, and the FCA has said you have to do it. And then from March of next year, no more LIBOR origination. So yes, it's a very apt conversation because it's timely. So going forward, what are you going to have? Well, yes, as you said, you lend fixed rate, no issue apart from the hedging. You lend SONIA, or you lend at Bank of England base rate. The SONIA market, the UK working group and the ARC in the US have all decided that the compounded, daily compounded set in arrears version of SONIA and SOFR are the more acceptable, will be the most acceptable form of floating rate for banks to lend to major clients. Outside of the major clients, they have a bit of a problem. Now, that's representing probably no more than 10% of the market in their view. And for those, they may have a further option, which is either Bank of England based or a term SONIA or a term SOFR. Now, those haven't been launched yet. Term SONIA is in beta testing, and I've seen the data. It's coming along nicely, but it's not authorized for use. It may well be that there will be a term version of an RFR, which is basically a forward-looking rate. So it'll be set on the day today, so that in 3 months' time, you'll know what your payment has to be.
So hopefully we'll get that forward-looking. So fingers crossed. Okay, very quickly, one last question, very just singular to the sterling market. If I am lending floating linked to central bank base, and I want its floating rate linked to the base, is there an issue with immunizing that back to SONIA, or is such a close correlation between SONIA and base that I could just keep that exposure to the base rate and not worry too much about it? Very quickly, what should I do there? You
broke up a little bit, but I think if I understood you correctly, then you've got base rate loans and base rate mortgages.
Yes.
The correlation between base rate and SONIA is, I would say, virtually 100%.
Yeah, absolutely. Okay.
I wouldn't really worry about it too much.
Absolutely. No, that's what I thought, but I wanted it straight from the expert's mouth to confirm that. Okay.
I think your problem is going to be, in all this, is that in times of stress, LIBOR has a bit of a safety valve in it, in that it contains an average of bank credit. So in times of funding stress, when banks' funding costs increase, the average credit, because of their credit spreads going up, the average credit spread is embedded within LIBOR, and so they get a bit of money back on their assets. That won't happen in a SOFR world and a SONIA world, because there is no credit spread.
Exactly.
So in times of stress, the assets won't reprice. And in fact, the asset rates are probably going to be falling at a time when the liabilities are going higher. So the real challenge for an ALM business is to understand that dynamic. The LCR and NSFR have certainly helped. The lack of reliance of banks on wholesale market borrowing now for their day-to-day funding needs has also helped. And so it is a smaller problem than it would have been maybe 10 years ago, but it is an issue. And
Absolutely.
so an ALM business needs to monitor that and monitor it. What impact does that have on the profitability?
And have an idea going forward. Very wise words. Thank you very much. Mr. Liddy, really appreciate it. Thank you for your company. Thank you for your thoughts and your wisdom. And I will see you soon, perhaps over lunch soon. All the best, my friend. Take care.
Bye-bye. Bye.